Hello everyone. In this video, I will be talking about partnership dissolution. So before that, let me share to you my slides. So partnership dissolution, before we start, let me present to you the learning objectives for the topic. So the first one is state the causes of partnership dissolution. And the number two, account for the effects of partnership dissolution on the partnership equity. What is dissolution? Dissolution is the change in the relationship of the partners caused by any partner ceasing to be associated in the carrying on of the business. For example, partners A, B, C, and then partner C decided to get out from the partnership, then that would result to a dissolution of the partnership A, B, and C. So there are causes of dissolution, and I will be mentioning four. We have admission of a partner, withdrawal or retirement of a partner, death of a partner, and the last one is incorporation of a partnership. In this discussion, I will be talking about the first three causes. So first, we have admission of partner. In the admission of partner, there are two ways on how a partner can be admitted into the partnership. The first one is purchase of an interest from one or more of the existing partners. And the other one is investment of assets in the partnership by the new partner. Our first discussion will focus on the purchase of interest. So first, we have purchase of an interest from one or more of the existing partners. So case number one, it's a purchase of interest from one of the partners. Assume that capital balances and profit and loss ratio of the partners in XYZ company are as follows. X, 80,000 capital with P&L ratio of 40%, Y, 120,000 with a capital at P&L ratio of 30%, and Z, a capital of 160,000 and a P&L ratio of 30%. Assume M purchased one half of the interest of Y for 96,000. So take note, it's between, or the transaction is between M and Y. So how do we record now the transfer of interest from Y to M? So this is our journal entry. So it is 1/4 of the interest, one half rather. It's one half of the interest of Y. If we recall, Y has 120,000 capital. So one half of that is 60,000. So it's a debit to Y capital 60,000 and M credit to M capital of 60,000. The 96,000 payment of M to Y is not recorded in the books of the partnership since the transfer is between Y and M only. And then after the transfer of interest from Y to M, so this would be now our new capital or partner's capital and its new P&L ratio and their new P&L ratio. So for X capital, it remains at 80,000 and the P&L ratio of 40%. Then Y now, since Y transferred one half of its capital to M, from 120, Y now will have 60,000. Then the remaining interest is 15%. So from 30%, that 15% or one half of it was transferred to M. So the remaining percentage is 15%. For Z, it remains at 160,000 and a P&L ratio of 30%, while M has 60,000 and a P&L ratio of 15%. Case number two, purchase of interest from more than one of the partners. We still be using the same problem with the same data. And the assumption is that M purchased 20% of the interest of each of the partners for 120,000. So 20% of the interest of X, Y, and Z. So what will be the journal entry now if 20% will be purchased or transferred to M. So from X has 80,000, so times 20%, it is 16,000. So it's a debit to X capital of 16,000. And then for Y has 120,000 times 20%, then it's 24,000. So debit Y capital 24,000. And then for Z, it's 160,000 times 20%, it's 32,000. So the total interest transferred from the partners to M will be 72,000. Okay, so again, the cash receipts and personal gains are not recognized in the books of the partnership since the transfer is just between the partners and the new partner, which is M. And then what will happen after the transfer of interest? So these are now their new capital and P&L ratio. So for X, from 80,000 minus 16,000, the remaining amount now is 64,000. For Y, from 120 to 96, so that's 120 minus 24,000 here, it's 96,000. And then for Z, from 160 minus 32,000, it's 128,000. And then M will have 72. As to the P&L ratio, remember that 20% was transferred to M, so the remaining 80% will be prorated among the old partners using their P&L ratio. So simply multiply the 80% by the P&L ratio of the old partners. So for X, it's 80% times 40%, or 40% times 80% is 32%. For Y, it's 30% times 80% is 24%. And for Z, it's 30% times 80% is 24%. You have to make sure that the total of the P&L ratio is 100%. Okay, so that's case number 2. Then we'll now proceed to case number 3. So for case number 3, we will be using the same data from case 1. So it's a purchase, this time it's a purchase of interest book value method. So M purchased 20% of the interest of X and Y. So this time X and Y for 100,000 and agreed that the sale will be accounted at book value of X and Y's capital account. So how do we transfer now the interest? So this is the journal entry. So we have 20% of 80,000, it's 16. Then 20% of 120 is 24,000. So we'll have a debit to X capital 16,000 and then Y capital 24,000. So a total value transferred to M of 40,000. So credit M capital 40,000. Again, the cash receipts and personal gains are not recognized in the books of the partnership. So after the transfer, what will happen to the P&L, the capital and the P&L ratio of the partners? So since it has to be at book value of the interest of the partners transferring to M, so it is 80 minus 16, you have 64. And then 120 minus 24, we have 96. As to its P&L ratio, we directly deduct the 20% from the 40% of each of the partners selling their interest. It's X and Y. So since X has 40% P&L ratio, original P&L ratio 40%, so minus 20, it has now a remaining 20% P&L ratio, and then Y, it's 30% minus 20%, a remaining P&L ratio of 10%. Then 40% will be transferred to M. So a total of 100%. Okay, then next we have case number 4. Purchase of interest, proportionate share. So the same problem. At this time, M purchased 20% of the interest in the net assets and profits of the partnership from X and Y for 100,000. X and Y agreed to share proportionately on the 20% interest sold to M. So the 20% rather is based on the net assets of the partnership. And then it's X and Y who agreed to proportionately share the 20% interest sold to M, so excluding Z. So how do we account for the transfer? So we have to determine how much amount will be transferred by X, by X and Y to M, we need to determine first how much amount should be transferred to M based on the net asset of the partnership. So it's 360,000. That's the total actually interest of all the partners. So it's 360,000 times 20%, it's 72,000. And then the 72,000 now will be shared by X and Y using their P&L ratio. So to share the 72,000 for X, the total ratio of X and Y is 40 and 30, the total is 70%. So for X capital is 40 over 70 times 72,000. So X will share 41,143. And then for Y, it's 30 over 70 times 72,000. Y will share 30,857. So same with the previous problems. So the cash receipts and personal gains are not recognized in the books of the partnership. So after the transfer of interest, this will be now the capital and the P&L ratio of the new partnership or the partners. So for X transferred 41,143. So from 80,000 minus 41,143, X now will have 38,857. And then for Y, originally it's 120,000 minus 38,557. It's 89,143. And then Z the same. Then M is 72. And then for their P&L ratio, the 20% will be sold or rather will be given to M. So this will be apportioned by X and Y using their P&L ratio. So the 20% will be the amount or the figure not to be deducted from their original P&L ratio. So 20% times 40 over 70. So deduct it from 40%. So the P&L ratio now of X is 28.57. And then for Y, 20 times 30 over 70, deduct it from 30% original ratio. Then he's now having 21.43%. Z remains at 30% and M will now have 20%. So a total again of 100%. Next, number 5, purchase of interest, revaluation of assets. So this is a new assumption or a new problem. Z purchases 25% of X and Y interest for 200,000. The carrying amounts and fair values of the partnership's net assets immediately before the admission of Z are as follows. So we have now the carrying value or the carrying amount and the fair value. So we will determine whether there is an increase or decrease in the respective assets. So the first one is cash, so no change, not change. Then we have equipment from 680,000 to 780,000, so there is an increase of 100,000. Accounts payable remains the same. And then we'll have X capital 260 and Y capital 440,000. The partners share profit equally. So what will happen? So in this problem, before we will transfer the interest to the new partner, we need to recognize first the revaluation of the equipment. So it's a revaluation gain, and this would increase the capital of the old partners. So we have a debit to equipment 100,000. Since they are to share profit equally, so 100,000 will be shared by X and Y equally. So we have a credit to X capital 50,000 and Y capital 50,000. So the adjusted capital now of the partners will be, for X 260 plus 50, it's 310,000, and for Y 440,000 plus 50, we'll have now 490,000. So these are their capital balances before the transfer. So journal entry to record the admission of Z. So Each of the partner will be selling 25% to Z. So we have X capital based on the adjusted capital of 310. It's 77,500. Then debit Y capital for 90 times 25%. We have 122,500. The total transfer of 200,000. So credit C capital 200,000. So what will happen now after the transfer? So X capital will now be reduced to 232,500. That's 310 minus the debit of 77,500. And then for Y capital for 90 minus 122,500, it's 367,500. And then of course Z, we have 200,000. For the P&L ratio, since Z will be given 25%, so the 75% will be proportionately shared by the old partner. So equally, so it's 75% times 50%. They both will get 37.5%. Okay, so this is the last topic for purchase of interest. I will now proceed to investment of assets. Okay, so before we proceed to some cases now or illustrative problems, I want you to be familiar with these terms. So first, we have total contributed capital. It is the sum of the capital balances of the old partners and the actual investments of the new partner. Okay, so capital of old plus investment of new. Then we have total agreed capital. It is the total capital of the partnership after considering the capital credits given to each partners. This is the true capitalization of the partnership. Then we have bonus. It is the amount of capital or equity transferred by one partner to another partner. Bonus can be given to the old partner, and also a bonus can be given to the incoming partner. The fourth one, we have capital credit. It is the equity of a partner in the new partnership and is obtained by multiplying the total agreed capital by the percentage interest of the partner. Next, we have scenarios that may occur when a new partner invests in the partnership. There could be three scenarios. The first one is actual investment is equal to capital credit. So what happened is that there would be no bonus. So for example, the actual investment is 1 million and then the capital credit is 1 million. So no bonus either to the new or to the old partners. The other one, actual investment is more than the capital credit. This results to a bonus to the old partners. For example, the actual investment is 1 million and then the capital credit is 800,000. So the 200,000 will be given as a bonus to the old partners. The third scenario, the actual investment is less than the capital credit. So for example, the actual investment is 1 million and then the capital credit is 1,200,000. So in this case, the bonus of 200,000 will be given to the new partner since actual investment is less than the capital credit. So let's start with our illustrative problem. Bisario and Beltran are partners with a capital balances of 400,000 and 200,000 respectively. They share profits in the ratio of 3:1. The partners agreed to admit Bueno as a member of the firm. So this one is investment of assets in the partnership by the new partner, bonus to old partners. So case number 1, total agreed capital or TAC or TAC is stated. So the total agreed capital is stated in the problem. So assume that Bueno invested 250,000 for a 1/4 interest in the business. The partners decided not to revalue the assets of the partnership and the total agreed capital is 850,000. So in this case, the total agreed capital is stated in the problem or given in the problem. So what you will do is compare the total agreed capital and the total contributed capital. So total agreed capital is 850,000 and the total contributed capital is old partners 600,000, new partners 250,000. So the total of 850,000. So in this case, total agreed capital is equal to the total contributed capital. To determine whether bonus is given or bonus will be given to whom, we need to determine it by comparing the actual contribution of the new partner with its capital credit. The actual contribution of the new partner is 250,000. And then the actual credit, remember, when you compute for the new partner's capital credit, it has to be total agreed capital. It's given in the problem of 850,000 times 1/4. So the capital credit is 212,500. So in this case, the actual contribution is more than the new partner's capital credit. So there is a bonus, and this bonus will be given to the old partners. So how do we journalize the investment of Bueno? So first, we recognize the cash receipts in debit to cash 250,000 and credit to Bueno Capital 250,000. And then after that, we will be recognize the bonus given to the old partners. So it's a reduction from Bueno Capital or the new partner. So it's a debit to Bueno Capital 37,500, and then the bonus will be proportionately shared by Bisario and Beltran using their P&L ratio. So for Bisario, it's 37,500 times 3/4. So a credit to Bisario capital of 28,125, and then for Beltran is 37,500 times 1/4. So a credit of Beltran capital 9,375. So the partner's new capital and P&L ratio right after the admission of Bueno. So Bisario will have now an increase of 28,125. So the capital now will be 428,125. And then Beltran will have an increase of 9,375. So a total of 209,375. And then Bueno will have a capital credit of 212,500. And for the P&L ratio, Bueno is given 25%, so the remaining 75% will be proportionately shared by Bisario and Beltran using their P&L ratio. So 0.75 for Bisario, it's 0.75 times 3/4, it's 56.25%. And then for Beltran, it's 0.75 times 1/4, it's 0.18 rather, 0.75%. So make sure your P&L ratio will total 100%. Next, we'll have investment of assets in the partnership by the new partner, bonus to old partners. Case number 2, still a bonus to old partners, but the total agreed capital is not explicitly stated. Okay, so assume that Bueno invested 400,000 for a 1/4 interest in the business, and a bonus of 100,000 will be given to the old partners. So since there is no amount as to the total agreed capital, it has to be understood that the total agreed capital is the total actual contribution of the three partners. So for total agreed capital, the old partners has 600,000 and the new partner invested 400,000. So the total agreed capital is 1 million. Okay, so take note, the total agreed capital is not explicitly stated, so it has to be understood that whatever is the actual contribution of all the partners will be their total agreed capital. So it's 1 million. And total contributed capital is 1 million, so a zero difference. To determine to whom the bonus will be given, actually it's stated in the problem that the bonus will be given to the old partners of 100,000. So if the new partner's contribution is 400,000, and then if bonus will be 100,000, then it has to be understood that the new partner's capital credit is 300,000. So capital credit is less than the actual contribution. So this would result to a bonus to old of 100,000. Once again, explicitly stated in the problem. So how do we account now for the investment? So first, we recognize the cash investment of 400,000. So we debit cash 400,000 and credit Bueno Capital 400,000. And then we recognize the bonus to the old partners by reducing the capital of Bueno. So it's a debit to Bueno capital 100,000 and a credit to the old partner's capital using their P&L ratio. So credit to Bisario capital 100,000 times 3/4 is equal to 75,000. And then Beltron capital 100,000 times 1/4, you have 25,000. After the admission, the P&L ratio and the capital balances of the partners are the following. So Bisario will now have 475 after the bonus of 75,000. Then Beltron has 225. That's 200 plus 25,000 bonus. And of course, Bueno, 300,000. Again, it's 25%. So we still have the same P&L ratio as the previous case. So since it's 25% given to the investing partner. Okay, then we have case number 3. The total agreed capital is stated. So this time, is a bonus to the new partner. So the previous problem, we are talking about bonus to old partners. So this time is bonus to new partner. Assume that Bueno invested 240,000 for a 1/3 interest in the business and the total agreed capital is 840,000. So we have stated the agreed capital is 840 and then the total contributed capital is also 600 plus 240, also 840,000. So zero difference. To determine really that bonus will be given to the new partner, we need to compare the actual contribution of the new partner with its capital credit. So the new partner contributed 240,000, but given a capital credit of 1/3 of 840, so it's 280. So since actual contribution or capital credit is more than the actual contribution, capital credit is 280 and then the actual contribution is 240, then there is a bonus of 40,000. So how do we account now the investment? So first, record the cash investment of Bueno. So debit to cash, 240,000 and credit to Bueno capital, 240,000. And then recognize the bonus of 40,000. So since it's a bonus to new, the bonus will be or will reduce the capital of Bisario and Beltran. So this time still the P&L ratio are to be used. So for Bisario capital, we'll have a debit of 30,000. That will be 40,000 times 3/4. And then for Beltran, it's 40,000 times 1/4. So it's 10,000. And then a credit to Bueno capital of 40,000. So after the admission, what will happen? So the Bisario and Beltran's capital will now be reduced to the bonus given to the new partner. So Bisario 400 minus 30, it's 370,000. And then for Beltran, it's 200 minus 10,000. We have now 190,000. And then Bueno, of course, is 280,000. Then it's 1/3 of the 1/3 interest of the partnership. So the 2/3 will be a portion or shared by Bisario and Beltran using their P&L ratio. So for Bisario, it's 2/3 times 3/4 is 50%. And then for Beltran, it's 2/3 times 1/4 is 16.67%. So make sure again, this will be 100%. Next, still bonus to new partners, the total agreed capital is not explicitly stated. Assume that Bueno invested 300,000 for a 50% interest in the business. So since the total agreed capital is not explicitly stated, as we mentioned a while ago, whatever is the total contributed capital or the actual contribution of the old and the new partners will be the total agreed capital. So total is 900,000, that's 600,000 capital of the old plus the investment of the new partner, 300,000, so a total of 900. So this will be zero difference. And then we will determine how much is the bonus to be given to the new partner. So partner's actual contribution is 300. And then to compute for the new partner's capital credit based on the total agreed capital is 900,000 times 50%, which is 450,000. Capital credit. So from 300 with a capital credit of 450,000, the new partner is given 150,000 bonus. So how do we record the 150,000 bonus? Rather, the investment. So first we will recognize the cash investment. So debit to cash 300,000, credit bueno capital 300,000. And then after that, we will recognize the bonus given to the new partner. And this will reduce the capital of the old partner. So 150 will be shared by Bisario and Beltran using their P&L ratio. So it's a debit to Bisario capital, 112,500. And then debit to Beltran capital, 37,500. Of course, credit to Bueno capital of 150,000. So after the investment, so what will happen to their capital and P&L ratio? So the new capital of the partners now will be Bisario, 400,000 original capital minus 112,500 bonus given to Bueno. So it's 287,500. And then for Beltran, 200,000 minus 37,500 given to Bueno, it's 162,500. And then Bueno, actual contribution of 300 plus the bonus of 150 is 450,000. So interest given to Bueno is 50%. So the remaining 50% will be shared by Bisario and Beltran using their P&L ratio. So for Bisario, it's 50% times 3/4 is 37.5%. And then for Beltran is 50% times 1/4, we have 12.5%. Next, still bonus to new partner. This time, the amount of investment is not determined, so there is no amount as to how much Bueno should invest to the partnership. So assume that Bueno wants to join the partnership through direct investment for a 20% interest. The net assets of the partnership before admission is 360,000. Okay. To get for the total agreed capital, so since it's not stated in the problem, to get for the total agreed capital, our computation should be based on the net assets of the partnership. It is stated in the problem that the net assets of the partnership before admission of Bueno is 360,000. Now, if Bueno will be given a 20% interest, and it has to be understood that the net asset of the partnership will be given an equivalent of 80%. So to get the overall or the total agreed capital of the partnership, then we will divide the 360,000 by 80%. So we have 360,000 times 80%. Where did we get 80%? It's 100% times, it's 20% now given to Buena. So the remaining 80% will be applicable to the 360,000. So to get the entire 100%, so we divide 360,000 by 80%. And that will be our total agreed capital, and that's equal to 450,000. And to determine how much Bueno should invest to the partnership, since there is no amount as to how much, so we'll just multiply this by 20%. So Bueno should invest 90,000. Okay. I did not give the journal entry for this one, but if you ask, is there a bonus or is there a bonus by given to the new or the old partner? Actually, there is no bonus given. So whatever is the amount invested, that would be also the capital credit. So if you would like to ask what is a journal entry, it's just a debit to the capital of the old partners. Of course, will be a portion using their P&L ratio. The P&L ratio of Bueno are rather Bisario and Beltran. So they will be sharing the 90,000, and then it's a debit to their capital accounts and then credit to Bueno. No, I'm sorry. This is not, I'm sorry, I thought it's a bonus. For this one, it's just an investment, no? So no bonus. So whatever is the investment, the amount invested, that would be the capital credit of the new partner Bueno. So it's a debit to cash, 90,000, and a credit of Bueno capital, 90,000. Sorry for that. There is no effect on the capital of the old partners. So it's just a debit to cash, 90,000, and a credit to Bueno's capital, 90,000. I stand corrected. Okay, so this is case number 5, but this is in relation to problem number 4. So assuming that after Bueno's admission in case number 4, the partners agreed to adjust their capital balances to reflect their proportionate shares based on their P&L ratio. So actually, the new P&L ratio of the partners are the following. So since Bueno will be given 20%, so the 80% will be shared by Bisario and Beltran using P&L ratio. So Bisario now will have 60%, and then Beltran now will have 20%. So they agreed that they need to adjust their capital balances to equate to their, or to reflect their proportionate shares on their P&L ratio. So what will happen? Okay, so this is how we will determine whether there is a cash settlement. So we have Bisario, Beltran, Bueno. So capital before admission, we have Bisario 400, Beltran 200, a total of 600,000. And then Bueno invested 90,000, so the total capitalization now will be 690,000. Okay, and Bisario has 400, Beltran has 200, and Bueno has 90,000. So how do we determine whether the partners would withdraw or invest more cash in order to equate to their P&L ratio? So simply multiply the 690,000 by their new P&L ratio. So 690 times 60%, Bisario's capital should be 414,000. And then for Beltran, 690 times 20%, Beltran's capital should be 138,000. And then same for Bueno. So what will happen? Bisario has 400 and is supposed to be 414,000. So Bisario needs to invest 14,000. Okay, so additional investment. For Beltran, Beltran has 200,000 capital but should have only 138,000. So Beltran should withdraw 62,000. And then to Bueno, Bueno should have 138, but she only has 90,000. So Bueno needs to invest more, 48,000. Okay, so after the cash settlement or during the cash settlement, this should be the journal entry. So it's a debit to Beltran capital 62,000. Why? Because Beltran has to withdraw. And a credit to Bisario capital 14,000 and Bueno capital 48,000. Credit because they need to invest more. Okay, so I have here a comparison between purchase of interest and investment in the partnership. So as to whether the investment of the partner or the new partner will be recorded in the books, actually under the purchase of interest, the incoming partner's contribution is not recorded in the partnership book. As I mentioned, it's just a transaction between partners. Then in investment, wrong spelling. In investment in the part of the partnership, the incoming partner's contribution is recorded in the partnership book. So we noted a while ago that we debit cash and we credit the new partners investment. And then for the capital of the partnership, does the admission of the new partner changes the capitalization? Actually, under purchase of interest, it will not change. The capital remains the same. While under the partnership, the investment of the new partner will increase the partnership capital. And both do not recognize gain or loss in the books of the partnership. Okay, so we're done with purchase of interest and investment in the partnership. So this time we'll be talking about withdrawal, death, and retirement of a partner. So we'll have this illustrative problem. The capital account balances of XYZ company on July 2019 before any necessary adjustment are as follows. So we have X capital, 300,000 with 20% P&L ratio. Y capital, 500,000 with 30% P&L ratio. And Z capital, 200,000 with P&L ratio of 50%. The partnership reported profit of 1,800,000 for the 6 months ended June 30, 2019. Case number 1. Supposing Z withdraws from the partnership And then he was bought out by his co-partners for 1,240,000 cash. So the net assets of the business as of this date approximates their fair values. So what we will do is, before we will record the withdrawal of partner Z, we need to share first the profit of the partnership. So share in the profit of partnership, the profit is 1,800,000. So to share, we make use of the P&L ratio. So just multiply it with the P&L ratio. So 360 for X, Y 540, and Z 900,000. So these are their adjusted balances after the sharing. So X now will have 660, Y will have 1,040,000, and Z we have 1,100,000. So take notice Z who will be withdrawing from the partnership. And these are our journal entries. So the first one is our journal entry to recognize the sharing of profits. And this is our journal entry to recognize the purchase of Z capital. So we debit Z capital at book value 1,100,000. And then why are we going to credit X capital? Because they're the one who bought out Z. So the 1,100,000 will be apportioned by X and Y using their P&L. So X has 20 and Y has 30, a total of 50%. That's why our fraction is 20 over 50. So X capital is 440,000 and Y capital you have 660,000. Okay, so after the withdrawal of Z, what happened now? This is still case number 1. So this is our amount after the profit sharing. And then after the withdrawal of Z, so these are the share because they're the one who bought out Z. And these are their shares. So balance after withdrawal, X now will have 1,100,000 and Y now will have 1,700,000. So the interest of the partnership remains the same for the total capital. Okay, case number 2, retirement, settlement of interest by the partnership. So this time it's the partnership who paid Z. So assume Z retires on July 1 with partnership settling Z's interest for 1,240,000. Okay, so this is the journal entry. Z capital 1,100,000. And then why are we crediting X and Y capital of 56 and 84? Because if you notice here, or based on our previous case, the adjusted capital of Z after the profit sharing is 1,100,000, if you remember. That's after the getting the profit of 1,800,000. By the way, I'm using the same problem in case number 1. This is just a different scenario. The first one is the partners bought out Z's capital, and this time is the partnership who paid Z's interest. So since C has only 1,100,000 and then the partnership paid 1,240,000, and there is, or the payment is more than its capital. So this results to a bonus to the retiring partner. I'm sorry. So the bonus will be shared by X and Y using their P&L ratio. So how much is the amount of bonus? Actually, Z capital is 1,100,000 and then paid by the partnership for 1,240,000. So there is a bonus of 140,000. So to share, It's 140 times 20 over 50. That's 20% and 30%. Total is 50. So times 20 over 50. So Z now will have, rather X now will have 56. And then for Y, it's 84,000. It's 30 over 50 times 140,000. So Y capital will have a credit of 84,000. Okay. And then credit to cash, 1,240,000. This is the amount paid by the partnership to Z. So right after the retirement of Z, how much is the capital of X and Y? So X now, since they are giving bonus no to Z, so we'll have a reduction of 56,000. So balance after retirement is 604,000 from 660. Then Y now, from 1,040,000 minus 84, we'll have a capital balance of 956,000. Okay, case number 3, the retirement is in form of non-cash asset. Okay, so we'll have still the same problem. So these are the adjusted balances after the profit sharing. So same amount, 1,100,000. So assume Z retires on July 1, 2019 and receives cash 1 million and land with carrying value of 200,000 and fair value of 600,000 from the partnership as settlement of his interest. Okay. Now what will happen is that before we let Z retires, we need to recognize first his share in the revaluation gain. And that would be the difference between the carrying value of land and the fair value of 600,000. So the revaluation gain is 400,000. And this has to be shared by the three partners using P&L ratio. So simply multiply the 400,000 by their P&L ratio. So X now will get 80%, 9, Y rather will get 120%, rather 120,000, X 80,000, Y 120,000, and Z 200,000. So after the revaluation gain, these are their adjusted balances. X 740, Y 1,160,000, and Z 1,300,000. So this would be the amount now, or the basis in determining or in the settlement now of Z's retirement. So we have the following entries. This entry will be for the revaluation. So it's a debit to land 400,000 and increase to the partner's capital based on their P&L ratio. And then this entry is our settlement, or the settlement entry for the settlement of Z. So Z's capital is 1,300,000. And then take note, how much did the business paid Z, or the partnership? The partnership paid Z cash 1 million and land of 600,000. So a total of 1,600,000. And take note, Z has only capital of 1,300,000. So it's actually, there is a bonus given to Z, and the bonus will be shared by X and Y partners. That is why they need to reduce their capital by the amount of the share of the 300,000. So 16 minus 13 times 20 over 50, 120 for X. And then for Y, 1,600,000 minus 1,300,000 times 30 over 50, 1,180,000. So after the retirement, what will happen? This is the same problem. I'll just go directly in here. So partners capital after the retirement of Z. So these are their adjusted balances now after the revaluation gain. So for Z's payment, sa pila man to is 1,600,000. So as I mentioned, there is a bonus of 300,000 because Z has only 1,300,000 and was paid 1,600,000. And the bonus will be taken from the capital of the remaining partners. So shared using P&L ratio as discussed a while ago. So for X now will have 620,000 balance. And then for Y, we have 980,000. So the capital of the partnership will now be 1,600,000. Okay, retirement payment in the form of non-cash asset, but what happens here? Assume Z retires on July 1, 2019 and will receive cash 1 million and land with a carrying value of 200,000 and fair value of 600,000. So this is the same problem. the one I discussed previously, from the partnership as settlement of his interest. But what happened here is that the settlement is pending at a specified date. So meaning Z was not paid during his retirement. The payment or the settlement was pending, no, is pending. So we'll have the same problem, but the difference is the capital of Z will be transferred to a liability account. So this is what happened. Sa debit to Z capital 13, X capital 120, Y capital 180. We don't pay cash or land yet, but pending siya. So we need to credit liability to the estate of Z, a total of 1,600,000. Okay, and then upon settlement date, so this is now the entry. So we just close the liability account we set up now during the date of recording. So we debit liability of estate of Z 16. Then this time we credit cash 1 million and land 600,000. Okay, so that was the difference. Case number 4, withdrawal fully depreciated asset. Z withdraws on July 1, 2019 and received cash 500,000 and fully depreciated equipment with fair value of 600,000 from the partnership as settlement of interest. Partners capital after the retirement of Z. So we have the same amount here after the sharing of profit. Now we're still using the same problem. Now, supposing during the retirement, Z was paid cash and 600,000 from the partnership set. It's a fully depreciated equipment, but with fair value of 600. So in here, there is a revaluation gain of 600,000 because it's fully depreciated. So 600,000 to be shared among the partners using P&L ratio. So X will get 120, Y will get 180, and Z will get 300,000. So the adjusted capital of the partners are the following: for X, 780,000; for Y, 1,220,000; and for Z, 1,400,000. So to record the settlement, it's a debit to Z capital 1,400,000. Debit cash 500, equipment 600. Then take note, X capital was and Y capital was credited. So this would mean that the old partners were given bonus. Okay? Why? Because if we're going to compare, the adjusted balances of Z is 1,400,000, but Z was only paid how much? 1,100,000. Okay? So there is a, this is 300,000. This one is 300,000. So there is a bonus of 300,000, and the bonus will be given to the old partners. Again, why bonus? Because the adjusted balances of Z is 1,400,000. This is the same problem. And the payment was 100, 500 plus 6. So lesser than the actual capital of 1,400. So the 300,000 is a reduction from his capital, and this 300,000 will be given to the old partners to be shared using P&L ratio. So this increased the capital of X and Y. So for X, sharing 20 over 50, so X will get 120. So total now, capital of 900. And for Y, 300 times 30 over 50, Y got 180. So a total of 1,400,000. Okay, so this is the end of my presentation. Thank you.